Uh, All right, well, it's October 19th, it's 1:30. We'll call the regular board meeting of the Montana Board of Investments to order. We've already been reminded that we're being video recorded. And if we could have the roll call, please.
Sure thing. Good afternoon, everybody. We have Carl England,
Here.
Jack Prothero,
Here.
Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Representative Ken Walsh.
Here.
All right, we have 8 board members present. We do have a quorum.
Thank you. Does anybody have a public comment on any issue within the board's jurisdiction? You got it so people can raise their hands or something?
Yep, and I'm seeing no raised hands.
Nothing? All right. We have the August 10th and 11th, 2021 meeting minutes. And we got corrected minutes this morning. Does someone want to,
I don't know if the corrected minutes had that I was absent.
That's
That's
the only
okay.
change.
that's
Yep.
the big change.
Oh, okay.
We had you as present. We were going to give you credit, but is there a motion to approve them?
So moved, Mr. Chairman.
Okay.
Second.
Any discussion at all? If not, all in favor, say aye.
Aye.
Any opposed? None. Audit committee report, Maggie?
The audit committee met this morning and I think everybody was present, so I'm going to keep this as brief as I can. I'll remind you all that the legislative audit division has been working on board of investment audits. They started their field work on October 18th and they're on site starting tomorrow, and they should be here through mid-December. Montana Board of Investment presented the draft Unified Investment Program statements to the Department of Administration on October 1st as required in the MOMS. The draft statement has also been sent to pension systems, university systems, state fund, and other agencies that prepare their separately issued statements. Let's see, they're currently wrapping up their enterprise draft statement. Staff are in the process of getting our unaudited STIP financials posted. Our statements are currently being reviewed by our GASB consultant. And I believe we just re-upped with our GASB consultants for the period of November 4th, 2021 through November 4th, 2024, and that can be renewed for a total of 7 years. Their current staff are currently working on the draft of the annual report. Let's see, in all of those, the draft UIP and enterprise statements and the draft annual report will be presented at the audit meeting on November 30th, December 1st. Let's see. Committee was presented with the draft Wifley report. That's our SOC 1 audit. What it's called, a SOC 1 type 2 audit. And the committee, it's weird. The committee voted to approve that draft, and I would bring to this board that we go ahead and accept that draft. There were no changes or comments to be changed, recommendations. So I would make that motion if I can, Mr. Chair, to approve the Wifley SOC 1 type 2 draft audit report.
Do we approve the draft as the board, or do we wait and
As-
approve the final?
draft-
The draft becomes the final.
It
with
becomes
your
the
action.
final because we had no changes.
It's not going to be changed.
Okay, all right. So that's a motion on behalf of the committee. Is there a second? Second. All right, any questions, discussion from anyone? Anybody online or watching? If not, all in favor, say aye. Aye. Any opposed? None. Motion passes unanimously.
let's see. One thing that did come up in the SOC audit that I just might as well get on the record is that they were questioning some HR documentation. But fortunately for us, those missing documents were relative to searches that the Department of Commerce had managed. So all of our documentation for the Board of Investment staff that have taken over those HR duties is good. The next thing is that the Board of Investment staff worked with Wifley to develop an internal controls compliance program. And we're testing modules right now. Is that right? Yeah, correct me if I'm wrong here, because I tried to write this down. Testing modules for the internal controls compliance program. And it goes along with a document that was presented in our packets that
Easily readable.
you needed magnifying glasses to read. But, there's nothing to approve on that. Let's see. Dan also during his presentation talked about the ARPA loan program that they're in the process of coming up with, developing a plan and criteria probably, and that he would update us as things progress. And that is my report.
Thank you. Anything that anyone wants to add or questions? If not, let's move on to the loan committee. Jack?
Okay, thank you, Mr. Chairman. The loan committee met this morning. We looked at one loan. We had quite a long discussion. And the loan committee approved the loan to Sleeping Giant Trampoline Center here in Helena. The loan amount is for Board of Investments part, $679,986, 10-year term at a rate of 3.58. And because that's under the amount that needs to go to the full board, the loan committee can formally approve that without a vote here. We had a short discussion with Louise. She's very busy updating the Intercap loan program that we've had some information on. And I think at the next board meeting, we'll be looking to approve some major changes in how we do business in the Intercap program that look like they'll be positive for the board. That's all I have to report. Is there any questions?
Questions? If not, and the loans within the committee's jurisdiction. So the
Yep.
board doesn't have to decide that. So we can move on to the Human Resources Committee. Terry?
The Human Resources Committee met this morning and did our annual review of the personnel evaluations for exempt staff in a closed meeting. We did not have time to complete that, so we will be meeting at 8:30 tomorrow morning to complete that. However, in the meeting, we did vote and approve the exempt staff compensation adjustments that Dan had recommended and the reassignment of Thomas Winkler to a different exempt staff position. And those were voted on and approved unanimously. That's all, Mr. Chairman.
And does the board needs to approve that?
Yes.
Correct? So on behalf of.
So I would make that motion to approve those. Well, do we need to separate motions, do you think?
No, I think we can do them in
Second.
one. Second, Jeff? Everybody was there, so, but any questions or comments? If not, all in favor, say aye.
Aye.
Any opposed? None. Comments from our PERS.
So, Mr. Chairman, just to be clear, the meeting tomorrow at 8:30 remains a closed meeting.
It is.
We'll continue to discuss personnel issues.
Correct. Maggie, you want to give a PERS
Sure.
update?
We met October 7th. Short, brief one here. Bill Holohan has returned to Ampera as our new deputy director. Our IT director, Paul, went back to MSU. So Bill will be taking over the project of our software conversion that may never end. No, I'm just kidding. We feel that.
Bill has longevity
As a-
guarantee, huh?
right, as a board, we feel that it has to come to an end eventually, but it's plugging along. At that meeting, we approved deferred compensation agreements for the 457 plan with Glasgow City County Library, Marr County, Plentywood School District number 20, and Wolf Point School District. We also were presented by our actuaries with the actuarial evaluation. I'm not going to get into too much detail because Dory will do that at our November, December meeting. But I will give you the good news. The market asset return last year was 27.47 or 48. And the actuarial asset return, which is based on that 4-year smoothing, if you remember, was 10.67. So life's good. The funded ratios increased for all plans, went down, actually, it decreased, I guess, in my mind. The only entity that was over 30 years was the game wardens. Just to give you an example, PERS went from 35 years to 28. HPORS went from 39, that's Highway Patrol, to 26. Sheriffs went from 21 to 18. Even game wardens went from 40 to 35, so they're making progress. MPORS went from 16 to 15. FERS went from 8 to 6, and volunteer fire went from 4 to 1. And of course, the judges is 0 because they're fully.
Negative 200.
Yeah. Well, it is negative something. So anyhow, that's my quick brief update. And like I said, Dory will probably present in more detail at our next meeting.
All right, any questions?
So, question. So does that mean all the plans are fully funded?
No, it means that they will fund within the 30-year
30
requirement
years.
under statute,
And
except
that's
for
under statute.
game wardens.
They're
So-
actuarially sound.
Yes, so what that means too is that we will probably, as an Impera board, have to bring legislation forward for the game wardens, or somebody will. We'll work with somebody to do that.
All right. Representative Walsh, you got any words of wisdom for us from the legislature?
Nope.
Any
Pretty
words,
simple.
any words at all?
No, but I did spend, actually earlier this morning, spent some time on understanding the coal severance tax trust fund and how that all works, or at least I have a concept of how it all works. Because that's always a hot topic at the legislature is what their comments, that the funding cash flow is going away and this and that. And in reality, trust fund just keeps growing and it's the rate of return that the rate of return is by statute, by constitution, that it has to be fixed assets that only place the investment, so they don't get the 27.48% return. And so, but that's the reality there. So, yeah. So it's good.
Well, as long as you're not going to make us take a quiz on the.
No, I'm not giving the quiz. So, but it was good to understand a little bit more of how that all.
Great.
flows.
All right. So if we turn to tab 2, then I think we can move on to the executive director report.
All right, Mr. Chairman, didn't have any requests from the prior meeting. You have both the August and on your desk, the September snapshot. Just to give you perspective, it's a 10 business day turnaround in order to get the monthly snapshot data, and then we have to put it together in-house. So if the mailing date falls before that 10 business days, we'll have the most recent version when you get here and give you the version that we have available. So you do have the September numbers in front of you. Sec lending, we have a memo in there describing our securities lending program. We reviewed this fairly robustly as part of the State Street conversation earlier this year. So if you have any questions, we're happy to answer those on sec lending. Based on a conversation with the board chair, we'll delay board policy manual decision until next meeting when we have the staff and investment sections in front of you. The technical writer who we employed to help put the thing together got another job a week before we were able to wrap up staff and investments. So based on a couple of board members' feedbacks as well as conversations with the chairs, we'll just wait to adopt everything at once as opposed to what we have in hand and then the other sections in November, December.
Does that work, everybody?
Yes.
All right. Yeah, Mark.
Do you want us to give you these so you don't have to print them all over again, or?
We're just gonna send you what's left. And then again, the pieces that I think do warrant your attention, we did add a policy on confidentiality and use of position. We thought that was a good upgrade to our ethics policy for board and staff. We also combined all of those governance documents that exist. So the resolutions are now in policy. The in-state loan program policies are now incorporated into the governance manual. So all of those elements that the board adopts to direct staff will be in one place as opposed to sort of scattered across. And then from your policy manual, we will develop the procedures manual, which are those things that the staff are responsible for maintaining, and sort of a desk manual for transition of staff as well. So that will be a project for next year. And the final item.
Before you move on, does
Yes.
anybody have any questions or comments about that? I will confess to you that I haven't read every page, but I have read significant parts of it, and I think it's a significant improvement.
Well done.
Yeah.
I asked Maggie a question.
Yes.
Did you think the technical writer, I mean, is that worth having somebody do that for us? Or were you impressed with that or comment on that?
I don't think they probably made as many changes as I would have. But
So are you looking for a job?
probably not. I just did this for the foundation at Montana Tech, an 82-page document. I'm looking to do.
Whether you're looking or not, you keep it up and you're gonna get one.
I have to say, though, I think this document is difficult to find things. I think it's going to take some time for me to get used to it. I always call Dan, though, and he's very good about steering me in the right direction. So I just think it's just going to take time.
Okay. Well, I just think it's a lot. I mean, I don't know that I could find stuff instantly, but I think
It's pretty
It's a lot
intuitive.
more
once you
readable.
really- Yeah.
and you know, the things I noticed is that parallel policy, you know, like I think it was like the way the committees were organized before, there were 2 or 3 different formats. So now it's a single format. So all of that kind of stuff just works.
The investment section, I think, to me, is probably the biggest improvement, and you'll see that instead of having the SMA sort of all cobbled together under one investment policy statement, you'll be able to pull what is the coal tax trust fund investment policy statement, what is the natural resource indemnity trust investment policy statement. So I think within there, you'll see market improvement, and then the other piece is a lot of our just general continuity. What is the continuity plan for the CIO, for the executive director, those staff sections will be a much better process, which is why it took longer. That's where we had the most work to do. So relative to the document before you, I think incorporating the in-state loan program policies into one place with the rest of our policies is an improvement, as opposed to having to
Different pieces.
gather from elsewhere. It'll all be in one place, codified. And I think to Director Peterson's point, once you get sort of in the rhythm of knowing, okay, Title 40 is staff, Title 700 or the 700 series is the
Specific
Montana specific investments.
And I like that section. That's really helpful to help you understand what all these different programs are.
She's just saying that because she's worried about getting
Yeah, that's right.
Mark's retired. too.
Okay.
Yeah, Mr. Chairman, and I like it, having everything in one place. Just minor suggestion, you might consider a cross-reference
We have
for
one.
the back, especially as we get used to this. An alphabetical cross-reference in the back, so that if you think of, say, where the heck is travel and lodging and meals, or you can look it up alphabetically in the back and then go to the appropriate tab.
And we have that.
Especially,
Are you talking a
That's where-
cross-reference in or an index?
I don't know what I'm talking about.
We
Because a
have that.
cross-reference would have cross-referenced with what we had. And you did give us one of those initially, which was very confusing. An index would actually, I called you and we walked through them because
Yep.
it was bad. But an index would be
Maybe-
alphabetical. That's
Let
what you
me,
talked
yeah,
about.
let me describe it and then you tell them what we mean. Okay?
I'm not so sure. Don't you think I'm doing a wonderful job of
Sorry.
being in control?
Yeah, I was gonna.
Representative Walsh, don't you think I?
Sounds like the legislature. House of Representatives. Maybe wanted an alphabetical
Index.
I copied.
index, cross
Thank you.
index. Thank you.
Gotcha.
I need all the help.
I
can
knew, no, I
get.
knew that's what you're talking about. That's why I was
I need all the
helping.
help I can get.
All right,
All right.
anything else?
Last item is we have the draft work plan for the subsequent biennium in the back with proposed meeting dates for 2022. I actually did check my calendar accurately this year, so these are not the weeks I have little man.
Did anyone identify a big problem? Well, I mean, is there something is there an important meeting that somebody absolutely can't make? Talk about now, or we could always do that in email if we need to, but I guess we're gonna adopt this.
Right, so we need you to adopt this, and then as we go through the year, if there are dates you want to change, we can do that easily enough. But the work plan itself for the biennium is a requirement of the governance manual that
Right.
you adopt. We touch on all these topics.
Okay,
I'll
Yes.
I'll move the proposal.
all right,
I'll second that.
all right. Any discussion, comments, criticisms? If not, all in favor, say aye.
Aye.
Any opposed? None, motion passes unanimously. Anything else, Dan?
Just to Representative Walsh's point, I've been asked to present to the Revenue Interim Committee on the coal tax trust and on the statutory and constitutional limitations or opportunities presented. That will be November 9th, I believe. And then I did have Director Schwinden, Director Graham, and I were asked to present to the State Administration Veterans Affairs Committee prior to this between our meetings. That went very, very well. It's always easy to go to the interim committees when you have a 27% return year. So this year, knock on wood, easy presentation. Subsequent years, John will determine my fate.
Yes,
When one of our guests was talking about the green sheets, are those the Sava green sheets that have
Yes.
all the retirement stuff? That's what I
Yep.
thought. Thank you.
So what was that? Explain that again.
The green sheets. So the Legislative Services Division prepares what they call green sheets that have basically the 12 charts that explain the pension systems numerically in totality. So our expenses, the pension system's expenses, returns, assets, unfunded liabilities, everything is contained within those sheets. So we're currently filling out, we have 3 tables that apply to BOI relative to returns, expenses, and amortizations. So we're filling those out for them.
What do they use them for?
It's their go-to sheets for, and maybe Representative Walsh wants to take that.
Well, so when they come in and talk about, Dory comes in or whatever about the game wardens for one, you can see where the actuaries have put the, number of years or those type of things, PRs, 35 years, I think it was last biennium, and now it's back down, you said 28 or something like that, so.
So it's a resource then for you.
Yes.
correct?
Yeah,
Wonderful.
and so it just explains that, and then also if there's annual adjustments and those type of things, what's in statute, because they have changed that over the course of time, whether it's a 1% automatic increase or those type of things, number of years. So if there's legislation coming up, you can look and see. I know one of the fixes we did, because I was on the SABA committee, was the highway patrolman and stealing money from someplace else. So,
That's
tiring.
I know I had copies in the past, but
Yep.
that would be very useful to have.
Absolutely.
We'll send that
They're really good,
Yeah,
yeah.
they really.
How frequently do you complete these?
biennial.
Okay, anything else, Dan?
That's it. Thank you.
All right.
Ask a question, Mr.
Oh, yes, sorry.
Uh, Given the change in our legislative liaisons, has there been any discussion about replacing? You know, or you heard?
I've not heard any discussions on the two replacements for the board. As soon as I get that, I'll forward it out to everybody.
I thought it was already done, but it's not.
No,
Okay, and
Yep.
yeah.
That's what
As soon as we get a
Right.
letter, we'll let you all know.
Ryan told me.
it's a need to know thing. All right, anything else, Dan?
No.
All right, turn to tab 3 then, and loan program, Doug? Is he coming in or
Nope, he's on the camera
he's on the camera?
and on mute.
There, can everybody hear me?
We can hear you and we can see you now.
Great, great. So I'm on the commercial and residential loan portfolio review. Thank you, Mr. Chairman and members of the board. So as of the end of August, the commercial loan portfolio balance was a little over 192 million, and that represents 108 loans. There's currently 6 loan reservations that total a little over $19 million. And we have 8 loans committed for almost $17 million. The portfolio, excluding the Veterans Home Loan Program, the Multifamily Cold Trust Homes Program, and the Intermediary Relending Program, has a yield of 2.62%. And there's no loans over 30 days past due. So a good clean portfolio. The residential loan portfolio has a balance as at the end of September, a little over 2 million, and that's 60 loans. And the yield on that portfolio is 6.26%. There's no outstanding reservations. We do have 2 loans that have FHA guarantees that are over 90 days past due. Those total a little over 122,000, or 5.87% of the portfolio. The Veterans Home Loan Program has an outstanding balance at the end of September of almost 48 million, and that's 275 loans. And the yield on that program is 1.69%. We have 3 reservations totaling almost 800,000. The projected yield on those 3 loans is 0.86%. There's 7 loans over 90 days past due, almost 1.2 million, or 2.45% of the portfolio. And in the Multifamily Cold Trust Homes Program, the balance at the end of September is a little over 5 million. Those 4 loans have a yield of 2.65%. They have 3 reservations that almost is 9.3 million at a projected yield of 2.53. And they have remaining funds available. It's 583,000. And no loans past due in that portfolio. And then lastly, the Intermediary Relending Program. As of the end of August, it's almost 4.8 million, and that's got 38 loans, and the yield on that is 2%. There's 625,754 available to advance, and we have 2 loan commitments out for 750,000, and we have no past due loans in the IRP program. So with that, I would open it up for any questions.
Questions for Doug?
I have-
Yes.
So it's easy to see that the FHA guarantees those loans for the residential loans that are past due, but on the Veterans Home Loan Mortgage, that seems like that just keeps growing. Is there any end in sight for these loans that are past due?
Well, you know, with the size of that portfolio, it's, you know, a fairly large portfolio. You're gonna have delinquent loans. That portfolio, the loan either has a VA guarantee on it or an FHA guarantee. There's only a few in that portfolio that have FHA guarantees, but they all are guaranteed. So in the event of default, the loss on those would be minimal.
Such a low interest rate, it seems.
Yeah, it's a very good interest rate for the veterans.
Is there a cap on that?
The allotment is $50 million as far as the total program. The loan cap is based off, the VA has a loan, a maximum loan amount, which I don't know right offhand.
No, but I mean, or it's, so it's
50 million.
50 and we're at
Yeah,
48.7, right?
yeah, yeah. There has
Almost
been,
48.8.
yep, there's been times where the Board of Housing has had to close the program to allow payoffs and principal reductions to occur so that there would be more funds available. So that will happen.
Still a popular program.
About that interest rate, of course.
Yeah.
If I could get that interest rate.
It's popular. Anything else for Doug? Thank you, Doug.
Thank you.
Appreciate it. Tab 4. Ms. Louise.
Well, hello again, everyone. Thank you, Mr. Chairman. Just very briefly, we went through quite a bit of this in the loan committee. So just some updates here on the quarter for the activity summary. You'll see that it was a quiet quarter, and seeing how that we're so busy with everything else, it was kind of a welcome thing as well. So this quarter, our commitments, they were up compared to other first quarters in the previous fiscal year. This year, we're up to 8.6 million, and average is about 4 around this time of year. And I really attribute that to the DNRC's proactive approach to getting commitments in place for potential ARPA funding out there. So that was a part of that commitment jump there. And the fundings there on the activity summary, you can see the fundings are low. So this year, usually we have about 6.3 on an average, and it's down in 2.9. Again, I really attribute that to the ARPA funds out there, that there's a lot of those projects are being done now with the ARPA funds. And so once that goes away, I'm sure Intercap will come back online. There really isn't anything else to report other than I really want to put out a kudos to the staff that I've been working with. Normally I'm just, I'm that weird kid that will does well just by playing with her own toys in the corner and staying quiet. But with this change, we have all these, I'm able to work with the other staff, with Julie Feldman, Polly Boutine, John Ramasco, Kirsten Haswell, and of course, Dan Villa, that's really working hard to pull this together, and I really appreciate their help on it. So I just wanted to put that out there to the board, that you have a great staff and they're a lot of fun to work with. And that's all I have for the bond program.
We did not pay her to say.
We didn't.
Well, I did.
Well, kind of.
Ramasco.
I just ask a quick question. I have to know where in Lewis and Clark County the half-fast drive is.
Thank you, Terry. I was.
I just need to know that.
Somebody had a sense of humor.
They have fast drive, you know, I probably should have looked that up before I got on. So I'm gonna have to look that up for you.
Anything else? So I'm confused. As always. The fundings are down. One more time. Why are
Oh,
they
sure.
down?
Sure, fundings are down just because there isn't a need to borrow right now. A lot of the ARPA funds that are out there has the ability for a lot of these projects that normally are type of clientele, the cities, the schools, and and whatnot, they have the ability now to use the ARPA funds, which is, free money. So why would they borrow? So at this point, they are not needing intercap. There are a couple of loans coming. Like I mentioned in loan committee, we do have a couple of large ones that will be coming through, but a lot of the small ones, especially with the schools, they're able to use those ARPA funds.
And where is that funded? That interim committee that,
No, that's direct. So the local government school districts got a direct appropriation, then they can compete for additional funds through one of the ARPA committees. So everybody got a little directly allocated, and then they can compete for more based on a formula set by the legislature. And by the legislature, I mean Luke Jones.
and does that, so every, I don't know, I understand this, and not, if I'm getting too far afield, just tell me.
Nope.
But, so every district got a direct appropriation, here's X number of dollars to
County,
use.
city, school district got X dollars for infrastructure needs. And then they can go back to the big state pool in a competitive way to get more.
Just ask a quick question. Do they have to spend that by X date?
I think it's January 1st, 2025.
Oh, so it's not imminent here.
It's not like a
Or 26, I can't remember.
25 or 26, yeah. But there's a long tail on ARPA as opposed to CARES Act that was a hard and fast December 31, 2020.
Thank you.
And Representative Walsh, I don't know if you hear, but what do you hear? I mean, are the districts, little school districts using it for
I don't know if
what?
the schools got theirs through OPI. And this money went to cities, counties. And so then everybody got a piece, 150 million, I think was right, Dan, got divided up, except the big cities got their own allocations, the three big ones. And then, so they got that money and so, yeah, what it caught everybody off guard is like in our little towns, yeah, they need the money, but then you got to get the engineering done and you got to get all those bids out and those type of things. So is it really turning the dirt over yet? No. But then they have the opportunity to go back and say, there's a minimum distribution again based on gas tax. And then they can get that and apply for the big pool of money. And they can leverage that because they have to come up with 20% or something like that. But they can use the ARPA money for the 20%.
That's one other question, because I know this is sort of off, but where is the money located? Is it, you draw it down from the feds, or is the money here in the state? It's here, we've got it.
We have a portion of it. We have 425 million of the.
Good, I want you to
Kirsten
be
has it
careful
all?
with it.
Yeah, she's managing.
It is a drawable fund. So the budget office and Department of Administration make a draw request from the Treasury once the allocation is used up at the state level. There was a $425 million, $450 million initial hit. And then once that's drawn down, they'll make another request and we'll put that into STIP.
So it isn't each individual entity asking for the money, it's through a state drawdown.
The state does the drawdown from the Treasury and then the individual locals do the drawdown from Department of Admin.
Thanks.
And how's that working?
Good, that was a drop in the bucket compared to the CARES Act money that got dropped on us earlier that we talked about previously, so. Other than yields are low in STIP, obviously, so there's that.
We're
that issue.
anticipating $1 billion drop and we were pleasantly surprised that it was only 450 million. So Kirsten started at 530 normally. She didn't even start at 525.
Wow, okay. Anything else for Louise? Or on this general topic? If not, thank you, Louise. Nice to see you again, as always.
Thank you. Thank you. Nice to see you all.
And we're at tab 5. And new commitments. Huh?
Supposed to be until like half an hour from now.
Well, do you want to leave? Because you can't.
Well, let's kick it off. And I only have one. It's really disappointing. Like last time we.
Well, that's why we got you early, because we wanted to spend a lot of time talking. Our disappointment in you.
So only one new commitment in private investments this time around. Mr. Chairman, members of the board, thanks again for taking the time and then listening to us. That was Crescent Asia Consumer Value Fund 3 on the board brief. Unfortunately, it is Fund 2. That was my mistake. I didn't catch that in the review. We also invested in Fund 2, but this particular board brief is actually Fund 3. So my apologies. Let's kick it off there. As I said, we are in Fund 2, so this is another re-up opportunity for us. We, about 3 years ago, invested $50 million, committed $50 million to Fund 2. This time around, in line with our average check sizes of about 50 million in this asset class, 50 million commitment to Fund 3. What we like about Crescent Point, it is one of those managers that's, it fits very well within the portfolio in terms of thematic view that we have, and also in terms of how the firm is run. It is a very deep, very experienced, stable team that has a long track record in this particular target market they're operating in. It is an internally owned company, firm, so we don't have any outside investors there. And with this thematic view, what I mean here is the focus on the sectors that are driven by domestic consumer spending and the urbanization in these particular target markets, speaking of Southeast Asia, predominantly China, Singapore, Malaysia, Thailand. So that is an area that we have very little investments in the portfolio in. So Crescent Point fills that niche for us. And we committed $50 million there. Fund 2 is on a very good track. It is early days, but you see the performance on the board brief is tracking very well. And I'll open it up for any questions or comments there. Everything else should be on there.
How much of the initial, in Fund 2, how much of the 50 million commitment have they drawn?
Question's going to come up. I should have looked it up. I don't know if you ever have it handy. I believe they're about 60-75% drawn. So
Oh, okay.
40-ish million or so.
Mr. Chair,
Yeah.
just a question. I can see the thematic and the urbanization and growing consumer market and so on.
Yeah.
But in these times, consumer apparel, health, it kind of rings a bell like, ooh, is that really a good area to be in? But I would assume, given
It is.
that market, it is.
It is a very interesting point. So it's driven around this whole e-commerce digitalization of the retail markets, predominantly I'm picking on China. I don't want to put too much emphasis on it, but as you know, there's quite a few people in China.
No, wait a minute, what's that again?
One of the interesting stats was there's over 900 million registered mobile users in China alone. So 900 million people with a smartphone, with apps, ordering stuff online, looking at social media, want to be in the mix. They want to have the same clothes as everybody else. They want to get the big screen TV. So it's a very, very strong tailwind in these particular sectors driven around apparel. So some of the companies, for example, that are in there is Baozhu. It's an e-commerce solution predominantly in China. So that's bringing all these brands to the digital internet and getting from that brick and mortar type environment into the digital world.
With China, what concerns do we have in regards to kind of government's overreach or takeover of these type of companies?
Concerns, there are obviously always concerns. We do tread very carefully in this environment, specifically in China. We do have some language built into our negotiated contracts and side letters around avoiding specifically state sponsorship, military type overreach, if you will. So that is built into our contracts with these managers.
So what that, Thomas, I don't understand what that means.
We're essentially.
What are you telling them? You can't invest in this or
Rockets
that?
and guns and.
Rockets and guns?
Yeah.
Oh, okay.
Anything that is
Lipstick's
directly sponsored. by
Lipstick's
the-
okay. is what you-
Okay,
Carl, this kind of stems from the executive orders that we have.
That's exactly what it leads
back to.
year or two here, I guess, and we added some language to specifically say, you know, to the extent that the US administration decides that you can't invest in certain areas, you have to follow those rules, because I mean, prior to that, I guess, you know, probably not many people had really thought about that, I guess, in terms of.
But that doesn't answer Jeff's.
Well,
So there's a risk, yes.
I mean, there's still a risk, so, and we still think about that a lot. We talk about it every single time we have, you know, this type of fund where we're gonna have those type of exposures. It's, you know, generally front and center questions about, you know, why do we feel good about the exposure that we're gonna have here? And obviously you can't guard against maybe everything, but
So there's a lot of subsectors that we're looking at with Crescent Point that are not on the radar of the Chinese government at this point. So point you're probably bringing up, for example, is internet specific, and education was one of those things that is in the media a lot, that's being revamped under Chinese governmental rules. So we're looking at, you know, a travel website app, makeup for women, food delivery type businesses. So it's not necessarily on the, you know, highest priority list for the Chinese government. What we're looking for in investments. That gave us some comfort. But yeah, there's always a risk there. What can we do if one of those companies gets taken over by the Chinese government? That's a good question. Not very much, unfortunately.
I think there's very little overlap there from what you're hearing in the news. Crescent isn't investing in those giant internet behemoths. right?
Yeah,
That's
yeah.
what China wants to
it
crack down.
almost seems like if you get too big, that's the problem.
Correct.
in China. You invest on kind of the more entry level, lower end. Yeah. And I guess I would also say that, you know, kind of a broad statement across maybe all of our managers is, you know, well, China's only a portion of this particular fund, so it's not like it's, you know, I can't remember what the 20% of
60.
60 China
60%,
historically
between
between 60 and 70.
Okay. But broadly, you know, the people that we hire to do these things, I mean, they're on the ground. They, you know, got tentacles everywhere, that they're certainly aware of these types of things. They have no incentive to, you know, go out and make that type of investment. So they're going to be, you know, experts in that area and you know, hopefully able to avoid those kinds of areas that, you know, are sensitive areas for either the government or government or whatever it may be.
Is the 60-40, is that a contractual or is that just an estimation of where it's gonna?
That is based on the historic allocation. They've been somewhere between 50-ish and 70% to China, and they're well aware of certain concerns and they're able to opportunistically dial that up and down a little bit. But we would expect to be 50-60% in China in this particular vehicle.
It's an Asia focused fund.
It's in Asia as a whole, yeah.
The headquarters is in Singapore. I think they will go where there's value in Asia. So it's not gonna be majority China. This is not a Chinese based team. They have an office in Shanghai, but it's really an Asia focused strategy.
So do you guys have an idea of what the our total kind of private investment into China is?
Yeah, we're actually going to dive into that in the next tab in our broader discussion on private investments. But it's currently, to answer that point, roughly 7% within the private markets.
Not to jump ahead.
Yeah. To tab 6 page.
Somebody already ahead of schedule, right?
Slow down.
Anything else?
And is there any other questions? As I said, that was the only one.
Thomas, Michael? Or anybody? Thanks, guys. But you're sticking around for the next one,
I
right?
can't believe I was told.
Well, let's talk about that. What's the pleasure of the group here? What's that?
I was gonna say, I don't think we need to.
We don't? Okay. You need a break?
Anybody else?
You're free to say yes.
Stick with me, No, I'm more than happy to roll right into tab 6.
All right, let's do that then.
Overall discussion on the private
Okay.
investments. All right. Thanks again. Here we are back. Just an overview, so I'm going to dive into a little bit more the first part of this entire presentation that is behind tab 6. For the benefit of the new members on the board, talking a little bit about the role of private investments. Why are we invested there? Why are they important? How do we do it? Kind of allocations, constraints, objectives, benefits we hit on, and then talk about a few of the risks that we're managing. International exposure, certainly one of them. And I hand it over to Michael, who's really going to educate you on the current view in the markets, current approach in our portfolio, and then of course our ongoing pacing study that we work on with RMK on a regular basis. And I'll drive it home hopefully with just an overview of the private investment process. I believe that was discussed at length with Ethan last go around, but I'm happy to dive into any details there, answer questions. And of course, we have a lot of materials, details in the appendix that we can certainly dive in. Happy to answer any questions there. I'm not going to walk you through 127 line items in there. So don't be.
And just for color for newer members of the board, the private investment team used to be one team with real estate, real assets all together. And so a lot of our processes, methodologies are all the same and one and the same. And so that's what Thomas meant by we'd already gone through it.
So I'll kick it off on slide 3 behind tab 6, just an overall view of the portfolio. And again, what are we trying to accomplish with these investments in private markets? And for the new members on the team, there's some statistics on there, some allocation ranges that we keep track of that we look at. Granted by the board, we have a range per investment policy right around 15%, which happens to be roughly the midpoint of the current range. So very happy about that. And then certain constraints that we keep track of: overall exposure to international assets. We try to keep cash at a minimum. So not, we're trying to invest the money and not just sit in cash, to say. Primary reasons, private investments, for one, of course, it's a very large investable universe. If we were to restrict ourselves to just public markets, we essentially are foregoing a very, very large chunk of the investable universe in equities alone. So just for reference, I believe there's roughly 2,600 companies with revenue over $100 million in the public markets. Privately held companies of the same size or larger of 17,000. So that's a large chunk that we would essentially not take advantage of if we don't invest in private markets. Secondarily, of course, outsized returns. We're all after returns. Historically, private markets have outperformed public markets. Just over the last 3 years, I believe private markets have added a premium over publicly traded stocks of over 30%. So that is something that we're interested in. And then third point, of course, diversification is one of the factors. The overall portfolio cap, John is mentioning, managing, there's a lot of equity risk in there. There's a lot of other risks in there. So we're trying to diversify with different sub-strategies in the private markets. Page 3, so that's my recap there. I'm going to move on unless there are any questions, comments, concerns.
Any of the constraints that you find A, difficult to stay within, and B, if you could wave your magic wand, you would
Be at 80%.
change?
No, there constraints wise, this is a very interesting setup here at NBOI. And you probably hear this a lot from peers. Just the setup, the way it is with the IPS ranges and having that latitude to move within that range is very much appreciated on our side. As you very well know, we can never really hit a specific target, and we'll always be struggling. It's like, well, how do we get there? Now we're overweight, now we're underweight. Public markets go up 10%. We're underweight. Well, what are we going to do? So in that regard, I'm very happy with the situation where we are in terms of any kind of constraints. If you have anything on the top of your mind.
A very good and timely question. I think a constraint that we are probably going to go over at some point in the future is the non-US exposure. It's third from the bottom bullet. No more than 30% of the asset class can be non-US. We're currently at 28%. We've had multiple discussions internally. With our pacing, we're likely to go over that. We do feel that is a constraint. It's a very low bar. Looking at a global portfolio for equity, non-US is 40%. That's the benchmark. And here's ours is 30%. And so we are, very US weighted. So I do feel like that is a constraint that we'll likely go over. And then John can add any comments there.
Yeah, like Michael said, we talked about that one recently, and we just kind of said, well, I said, let's do it at the April board meeting when we normally come with some IPS adjustments there, but that's a pretty minor kind of tweak, I guess, if you will.
But
Certainly not a top level asset allocation
the
decision.
benchmark is at 40%?
Well, in the public space.
Okay.
So if you looked at the publicly traded stocks, the equity would be more like 40.
So a lot of these constraints are the board's attempt to control risk. And so is there other things that are not in this list that the board should consider in our effort to always control risk in this sector? Is there some like best practices that others may use, or because one of the things I really like this allocation, I think it actually should be higher, but I want to make sure that we understand the risk here, and that's where some of those constraints come from. So is there other things on a high level that the board should look at to handle so that we can analyze and try to understand risk in this space?
I think the ones that we have listed here are probably at a high level, the most useful, most appropriate. The only one I could think of would be maybe illiquidity, which is monitored on the risk side. Dan Zarling and the team. We have constraints around that too, if I'm not mistaken, in the IPS.
So I should, as a board member, feel comfortable that we're managing risks with these.
I hope you feel comfortable, yes.
Well, I do, but that doesn't mean I don't worry.
John,
I think
or
you're
Mike,
right.
anything to add? Michael?
I think that this is a good structure that allows us flexibility to invest in what we think are attractive risk-adjusted returns. I think some other peers might have tighter bands on what happens within private investments. Maybe they want 80% buyout, 5% VC, and 10% credit, and 5% other. And then you are, narrowly defining what happens in this portfolio, where I think as stands, you have transparency in the portfolio, but we are not limited by these artificial boxes or guidelines to really find, alpha in the portfolio. So a good example of that is we don't have a limit on private credit. Our private credit portfolio is returning, mid to low teens type of returns. That might be a lower return for a private equity return, but in comparison to fixed income, that's a lot of alpha between the two. And so we have the ability to do what's best for the overall portfolio in this portfolio, not just look for, 5x VC type returns. So I think I would say that the flexibility allows us to look at risk and take risk where we want. So to your point, you're not exactly managing down the risk, but you're allowing us to take risk to drive returns, which is in my view a plus.
Okay.
A quick note on the international exposure too. So that has been part of our conversation for the 2 or 3 years now that we've been telling you, the board, that we are intentionally increasing that allocation. So I'll point that out. That doesn't come to a shock or a surprise, hopefully to anybody, that that number is what it is today.
And you remain comfortable that we have the capability to adequately assess the international, the companies that are investing internationally? I mean, you
Yeah.
can,
Well, again, a lot of it is thematically driven, so we're not indirectly sourcing individual companies in Singapore. It is more that consumer-driven theme, for example, Crescent Point that we just talked about, and others, that we then hire the managers that we have high conviction in to go out and do that for us. Again, Michael and I were not underwriting the individual travel agency in the Philippines. We certainly can't do that, but that's where the relationship with the managers comes in. And I'm very comfortable with the folks that we have in the portfolio, Crescent Point being one of them, and others that play in that arena. Hence the commitment to that strategy.
if we raise that, would it be your anticipation that you would
Go ahead.
stick with your high conviction managers, or would you, or do you have some on the bench at this point that you would like to fund that you can't because of the 30%?
There's 1 or 2 in the pipeline that would probably drive us over that threshold at this point, that we have not put the brakes on, but certainly dragged our feet a little bit, so to speak, to have that discussion prior, before we make that commitment there. But the focus will always be on the high conviction names. But as you know, our checks are increasing as well. The allocations are increasing to those managers. So even if we stick with the high conviction names, ultimately the exposure will be higher, even though if it's the same number of investments.
So just to piggyback on what Thomas was saying a little bit, you know, as we've noted, it's virtually impossible in this space to really, you know, say, oh, well, we're going to be, you know, only 30% international or something. And so, you know, not that we're out there trying to violate the guidelines, and we're certainly aware of, you know, kind of where we're at. You know, we have been sneaking up on the 30%. You know, part of my comment about April was, well, okay, you know, it's possible that we could trip that trigger next week for all I know. And if the public equity markets declined, all those percentages start to change pretty rapidly. But we do have within the policy statement, you know, if we're outside of something like that, which honestly, I consider that one fairly minor in the scheme of things. If it's the top level asset allocation and we're outside of ranges or something, okay, that's probably a bigger deal to me. So we'd have to come and report that to you. But I guess, you know, I wasn't particularly worried that, you know, that's a 4-alarm fire that we've got to go move that range. And I don't think it's, you know, hasn't really been a lot in the conversation of things that we've been doing, at least up to this point. I was like, oh, well, we better not do that because we might trip this over here or something like that. It's just that over time, like you said, because it's been a focus, I think we've sort of snuck up on that particular limit, and, you know, would feel comfortable coming to the board and asking for a little bit more there. So.
Carl, to your question, I would say we're not going to fill the bucket for non-US just because we have 35 or 40% because you give it to us. I would say we got to this number from a very bottoms up manager focused approach. And then we were like, oh, wow, we're getting quite close to it. It's been very manager strategy, opportunity set focused. It wasn't, we have 30%, let's go fill this with.
Yeah, no, my question was whether or not we were foregoing opportunities at this point with new managers because we're at the limit.
I think Crescent will probably push us over the limit. We might even go over the limit without even doing Crescent just because of
Right.
private commitments and where we're at and what we've been doing the last couple of years. So we could go over without doing any new commitments, but it would restrict us from doing We're right at the line now.
I mean, if we were hitting it, we're over it, and then, we come and report out to the board and you're like, no more or something, okay, well then, we're restricted, obviously, but I don't think that's been typically the case.
I just want Michael and Thomas to have something to do. I'm worried about
They're okay.
Okay.
They're all right.
So if you break out of that, do you differentiate between, I mean, do you just, go from 30 to 40%, or do you start to break out that 40% international into different international geographies? Start to put, an underlying cap on, I don't know, China's the red flag for me, because you just read a lot about it, and you read a lot about the high profile issues there. It's what you guys are getting into, but it's obviously something that you hear about.
I guess I would kind of argue not, because A, it kind of adds another layer of complication and it tends to, put yourself into a corner with something like that. And B, we don't really control it a lot of times. So you have a manager like this who, yes, historically they've done, 50, 60, 70% in China, but they may not be now. And you want them to do what they do, follow their strategy, after the best returns that you can get. And I think to put, some constraint around it like that would just be, we kind of artificially constrain the strategy, and then it might steer us away, I guess, from what we might consider best opportunities in some instances.
John, do you want to talk about in the underwriting process, how we look at, for instance, how we collateralize things that may be in China, just to make sure that should there be, we're mitigating risk in the
I
underwriting
think
process.
that's kind of mixing managers, because it's more Ethan's world for a different one.
Well, I guess I want to get to the point of China generally, because it is thematically something that at my level we're dealing with, and I think the board certainly is going to have questions about it, but I think it's more than just the geography spread, but depending on the managers, there's specific elements that we can build in to protect the board.
I guess I'd say a couple things is, one, it's the second biggest economy in the world.
Sure.
And, it's just not realistic for, frankly, I don't think we're doing our fiduciary duty if we were to just say, well, we don't want to be there because of the obvious political risks. B, it's not really a large piece at this point, 7% of the private investment portfolio. Can't do the math in my head that quickly, but that's a 1% position, 2% position in the overall pension fund. So, it's not a huge piece. To Dan's point, depends on the strategy. But, the managers are certainly not unaware of those sorts of issues. So, they're doing what they can to mitigate, whether it's, the structure that they choose to access some of these companies with. Just kind of referencing one that I think will probably come before you. The one I was thinking of before that had a smaller exposure, but they're more of a debt-oriented structure, but they will have investments in China, but they will also generally have a path to collateral if they needed to, they bought something and it doesn't work out and they need to repossess something, they can access collateral that's outside of China that's put up by the owners. So there's, protections in place there with that. In this strategy, or, Crescent Point, more of an equity strategy, that's probably not as possible to do some of that. But to the extent that they can, managers are going to think about things like that to try to structure things in ways that they can, they can recoup something if things go bad, or if the government does whatever to them. Doesn't mean there's no risk by any means.
Sure.
I mean, these are
But
riskier
like you said,
strategies, but
it seems like overall the concentration is you can frame it in the 7%, less than 2% of overall, cap assets. Seems like you guys have, kept it well within a reasonable tolerance.
Note on the managers too, they're well aware of what US investors generally are facing, and just some people ease as well. We're not out on the fringes doing these type of investments. This is broadly accepted in our peer group and others, institutional investors. So we're not trying to do something weird, strange, and nobody's investing in. That. That's not what we're doing. And the folks, Crescent Point and others that we have in the portfolio are well aware of what U.S. pensions particularly are facing in the U.S. and they are conscious navigating around these issues. To John's point earlier, these folks have an 18-year track record on the ground in Southeast Asia, China. They're well aware of what's going on, impacts and influences their investor base, and they're not going to go out and say, it's like, oh, this is the greatest opportunity ever. It's going to screw every single U.S. pension that we have in the fund, but we're still going to do it. It's like, no, that's not how they approach it either. We're good.
We're good, thank you.
Moving on quickly. Keep it a
Page
relative-
four.
Sure, page 4.
What's that?
Slide 4, and I can move through some of those a little bit quicker. It's just an overview of the individual sub-strategies that we look for and that we invest in to achieve the aforementioned objectives, broken down by the 4 major buckets. Opportunistic is really just something that doesn't quite fit any of the other 3, so it could be anything. And buyout simply spread out by the individual EBITDA revenue sizes of the underlying companies. I believe everybody has an idea of venture capital stages, early stage life stages of the firms, what that does. And then private credit, Michael mentioned investments. They're very similar to what's going on in the public fixed income portfolio, just not publicly traded. I'll move to slide 5, and I believe that's also relatively familiar. I think Ethan has used that in one of his presentations, that 4-quadrant approach. And Michael and I are really focusing more on that right-hand side, the private equity, private debt, but sometimes through the process of investing in a private company, that might get taken public. So we do get some public exposure there, and the manager is trying to move through that process and sell down those public exposures. So we might have some there, but it's usually temporary. And we're not actively seeking out public equity investments in this asset class. We got other folks who can do that much better. The next page, 6, objectives, benefits. I really touched on this already at the intro. Looking for differentiated exposures, outsized returns. We want to take advantage of a large opportunity set in pursuit of those returns through the different asset classes, and differentiate or diversify the overall cap portfolio with some of these exposures that we have in here. Happy to dive into any specific details, but I think I touched on those on the earlier slides. Move to slide 7. Of course, we are taking risks. We're well aware of that. We're kind of leading into that discussion a little bit, how we monitor and manage those. But yeah, some of the big ones out there, certain strategies, sector allocations, country exposures, we'll touch on that. And of course, we have the individual managers themselves. How do they operate? How do they run their business? And then liquidity risks, cash flow timing, all of that. We touch on that. That's a big part of the pacing study that we do on an annual basis. And a lot of those are monitored constantly through the guidelines that we have from you guys, and then guidelines that we set internally ourselves. Vintage year was another one. We'll touch on that briefly. We'll go into a little bit more detail there, just for the benefit of the newer folks. Maybe a vintage year is really the year where a manager calls down the first dollar from our commitment and invests it. So Crescent Point, for example, if they were to call capital next week, invested in a first deal, that would be a 2021 vintage year for that particular fund. If they hold off and wait until January 2nd, then it would be a 22 vintage year. And that's important simply because we're trying to manage around not having all the eggs in one basket, so to speak, and not having an over allocation to one particular vintage year. You ask me, how do I know which one is a good vintage year, which one is a bad vintage year? And it's like, well, let me know, and we'll make a lot of money. But unfortunately, I don't. I can't predict that. That's why we're trying to diversify and spread across multiple years when we make commitments. That's why we have pacing in place. You'll see later, we make a certain number of commitments every single year and try to hit that on an average basis, and not have, $1 billion allocated in 2021 and then nothing in 2022. And it turns out 2022 would have been the great year and 21 was bad. And we look pretty stupid. So trying to avoid that scenario.
You know, we try to avoid looking stupid.
I got that. Yeah. As you can see, that's not a rule that I follow. Yeah, Thomas, I think you've answered, or Michael's answered this question for me before, but I apologize. What's the commitment like with this new one? Do they give you an outside date on when they're gonna do their first investment? Or?
There's usually some transparency into when the capital calls for Crescent Point specifically. I'll anticipate that call will come here in the fourth quarter.
Okay.
And so anticipation is there that this is a 2021 vintage year fund.
And that's through your discussions with them?
Discussion with the manager correctly. They outlined the pacing themselves, how the previous fund is deployed. So the question earlier, I wasn't unfortunately able to completely answer, how much money do they have there in the ground already? So to start raising the new fund. And that's coming from discussion with the managers themselves. They spend a lot of time internally projecting that out, when do we need what money? When does it go? Does it get invested? How many opportunities do they have?
Is there any contractual obligation to invest it by a certain?
I will
make an initial-
touch on that in a little bit as well, not to jump ahead again. No, there is, each one of these limited partnership funds has a certain investment period.
Right.
Somewhere between 2 to 5 years or so, depending on the strategy and the sub asset class. Within that period, the manager is obligated to call the capital.
Is that by contract?
That is by contract, essentially, in the documents, yes. So there's very little room post that particular period for a manager to actually make another new investments. There's a little bit of wiggle room to allocate some more money to an already existing investment, but most of them are restricted from having a completely new deal in the fund post that investment period.
So kind of clarify that for me a little bit. The one you just gave us has 4-year investment period.
Correct.
So what happens if they don't draw it all within the 4 years?
That money is unfortunately not allocatable anymore, if that's a word.
They can't call that capital.
They can't after.
It cannot.
Unless it's for like a follow-on to a platform investment, but they really can't make any new investments post that period.
You'd have to agree to anything. It'd be a new agreement. Is that it?
Yes.
And is, in reality, is that what happens, or in reality, do they say, look, we're beyond the period, but we want, we say yes?
They would have to ask for an extension of that.
Has that happened? I mean, why would you approve a manager if they're not going to put the money to use?
So it depends on your philosophy. Someone like a very large pension wants all of the capital called because they want that money invested.
Right.
Someone like us is probably a little bit more varied, where we want our managers to invest in the best opportunity set. So if things are really expensive, we don't want them just to spend it all and invest it just to invest it. We want them to be thoughtful about their opportunity set. So there are two sides of the coin. But there are managers that ask for an extension. It does happen. And then there are, on the flip side, also managers that will invest everything in 1 year instead of 5 years. And then you'll be like, do you think that's too quick? Why did you invest? Have this vintage year concentration, et cetera. It might be like it's been the greatest opportunity set of all time. So that's why we did it. So there is a wide spectrum of investment pieces for me.
So do you actually have those conversations with them then, saying, hey, I think that was, you do? Good.
Carl, to your point, so generally speaking, on average, the funds probably invest somewhere between 85 and 95% of the capital commitments in the investment period. There's always a range. There's always some reserves that a manager holds for unforeseen add-on acquisitions and so forth. So it's very rarely, and I don't know if I've ever seen it, that actually 100% of the commitment was called on the day of the investment period.
Right.
There's always some flexibility around it, but traditionally it's in that 85, 95% range. say.
And just, again, this might be neither here nor there. If they ask for an extension, do they have to get it from all the investors in order to be able to do it?
It depends. Sometimes it could be just from the advisory board. Sometimes it's a majority, sometimes it's a super majority. Sometimes it's from the entire LP base. Majority, super majority. So it depends on the specific documents. But generally, it's a majority of some group of LP group.
And then once that group, once they make that decision, everyone else is bound by it, right?
And there are some of these things where we will get requests of whatever variety where we might be perfectly happy, we'll vote for it. We might in other instances vote against it, but the rest of the LPAC committee, as an example, voted for it. And because we were a minority, we're dragged along, doesn't matter. So, you know, bound by the contract and what the other LPs are doing as well.
But it's not a situation where they'll get it from somebody else and not take it from you.
No, right, so it's gonna be an all or none decision for everybody that's in that fund,
Okay.
based on whatever the contract. You know, the decision-making group.
Of our private equity investments, how many LPAC boards or groups do you sit on? Do we sit on?
So we got 127 line items in the portfolio currently, and I want to say 20 or 30 of them were sitting actually on the LPAC.
Many more as of recent. If you look in the appendix, it has
Yeah.
the exact number and which ones we're sitting on.
That's, yeah.
I don't know the exact number, but it feels like too many.
Is it too many?
It feels like too many.
It's an obligation, right?
You know, the structure of the team was different before. There's 5 people for all the privates, and so a lot more people to go to these LPAC meetings. And now that's 2 people and 125 line items. We're much more selective about where we are. For the LPAC seat.
And is it required that you attend in person?
No, especially not currently. I think pre-COVID, it was the expectation just generally that you're going to be there as an engaged partner to the firm.
Just counted it's 48 that say yes. Is that what we're looking at?
48, okay. So 30 was like slightly off.
48.
So 48,
But some of those, I presume, are the same relationship.
Yeah, some of
We
those
might
are
be in fund
double
1, 2,
counted.
or
Oh,
3.
I see. I didn't. I was just
multiple
going right
funds.
down to yes.
Newburgh
Yeah.
Berman comes to mind.
Yeah.
We are in 4 funds invested.
then,
We're on
yeah.
the LPAC.
So maybe it's
3 of them.
30 entities. Yeah.
Yeah, so that probably. I can follow up with that number.
and when, Michael, when you say you're being selective, I mean, what are you selecting? Is it the size of the investment that governs the, your selection, or is
It
it?
depends. You know, someone like $5 billion manager with CalSTRS, NYSTRS, big European LP. They're like, you know, they're on a fund 10. We don't need an LPAC seat there. We're a small investor. We're probably not going to sway a lot of things. They have a very institutional LPAC. And so, you know, we might say we don't need a seat, or we'll just take an observer seat just for informational rights. Whereas a new VC fund, that's $200 million, that's a fund 1, and we're the anchor investor. In that case, we want to dictate and have say over the firm strategy. And so in that case, we're more likely to ask for an LPAC seat. So really just it varies. But I think historically, we used to ask for LPAC seats for all funds that we were in to see if we can get one. Where now, I think that there's already a good LPAC, then we might not ask for a seat anymore.
And you say you ask, what's, I suppose it's different every one, but what's the criteria for getting on it?
A lot of times it's the investment size that we come in with.
Okay.
So to Michael's example, $5 billion fund that has CalSTRS in with 300 million, our 50 may not seem as significant. So there's little leverage that we have. We can always ask, we might not get it. So, but then other funds, yeah, we're looking at another one right now. It's about 400 million or so of total fund size. We're looking at a commitment of 50 there. So that is significant to the partner, to the manager. We are on the LPAC in the previous fund, so there's a big chance and a very good likelihood and emphasis from my part to be on that LPAC again.
Sometimes it's not really at size. Sometimes they just want a good advisory partner to think about, what other LPs are doing, what their firm should be doing. Someone to kind of talk ideas through of the strategy. So it can really vary.
Well,
Slide 8.
according to Jack, yes.
I'm trying to keep them off the can. Slide 8.
So this is really the section where we dive into, a little bit of the layers of the portfolio. We're leading up with just some quick overview, performance and allocation size. Just a quick note on the performance. The 1-year number looks great.
Yeah, it does look good.
Looks great. Not taking credit for it.
Keep
And we're
that up,
really,
please.
I cannot guarantee that we will have that next year again, unfortunately.
That's because you're moving to real estate.
Real estate will be 40%.
Did
No,
we got that down? Did you
yeah.
get that down?
It's taped.
The numbers that I wanted to highlight here, obviously much more long-term focused in this asset class. So the 1-year number is just too volatile where we can't really judge by that significantly. So we're looking at 10 years since inception. That's the number I wanted to highlight. 13% since the late 80s, annualized net of all management fees, all performance fees to MBOI. So that is a strong performance. Again, we can't credit ourselves for this. This was partially done before we even came here. But that's the reason why we invest in this asset class, to achieve returns like this over very, very long periods of time.
Annualized, net of fees, compounded, correct?
Correct.
It seems like, remember our endless discussion about what the right benchmark was?
Oh,
No,
you're not gonna
no,
do
wait,
it.
wait, wait. If you're gonna ask a question.
We're walking out.
So, I don't remember that discussion, and maybe I've just tried to forget it, but we always said it lagged if the public markets are doing well. We always said that because there was a lag. So obviously the public markets did well in the last year. We did not lag.
Correct.
So
We did
What-
lag in the last
We
year.
did lag, just, it's still very good.
Markets were a little bit stronger than this, if you look at their.
we must be doing a different time period. What time?
So the numbers on here are as of fiscal year in 6/30.
Oh,
So
6:30,
whatever
so
you
we're
may have
not,
seen
we're
earlier.
doing different than the one for the board. Oh, okay, yeah, okay, got it. Yeah.
Yeah,
But we could
that's
have that
another reason.
long-term discussion. We could, if everybody wanted to do that.
That's at 7:30 tomorrow.
Okay.
In Great Falls.
Outside the parking lot.
Right, and Thomas will lead that.
I'll be here. Total market value just over $2 billion as of 6/30, and as I mentioned earlier in the onset, right around 15%, which is that midpoint of the IPS range. That's where we are currently. Moving on to pages 9 and following, I'll move through these relatively quickly too, just to break down visually of that discussion that we heard earlier, the 4 main subcategories. You can see here buyout is still the largest portion. If you remember our discussion, we are actively trying to diversify that overall bucket. Just for reference, 2019, last time we had this discussion, it was at 76, no, we had it written down, sorry, 71% in buyouts. So we are edging that down, and primarily to the benefit of private credit, to Michael's point earlier, which was at 14% 2 years ago, and we're now at 19.
So if I remember this right, the venture was always challenging.
Venture is an interesting beast. Yeah, we may not have the access we want to the top tier managers
Because of public.
That's part of it. Yes, there may be other reasons. It's not a super high priority. There's a lot of risk in venture capital as well. So you really need to be very, very careful where you allocate your money there. we've traditionally been around that mid-teens allocation. That's what we're comfortable within that portfolio. So I don't see that changing dramatically in 2 years from now, a venture being 30% of the overall private investment.
But there's a significant amount of risk in the VC area.
That's exactly the reason why we don't want that to be, 50% of the overall bucket. It's just trying to balance that risk.
Whereas buyout is much safer.
Different, different risks.
The other thing with VC too is just the size of the funds that come, they tend to be much smaller. So whereas we've got a, 50 million kind of average bite size in buyout, it's just not possible typically. I mean, they won't take 50 million from us because they're just not that big a fund. The last couple of funds that we were in were
21.
a couple $100 million, we did 25. So just you can't scale up there as easily.
Ron, but bottom line, VC is relative to this.
It does, but it's also had fantastic returns too. I mean, on the flip side of that.
Okay.
But it definitely, the dispersion of
Dispersion of
returns
returns
within
is much larger.
VC is, you can have terrible returns in some funds and you can have just out of this world returns in others. So that's why they're selected.
In general, I would say like median buyout return is still pretty good. But in VC, you really want to be in the top quartile or even top decile. Or, yeah, it's still very wide.
So, explain that. Yeah,
They're really driven by the biggest returns, the Ubers, Airbnbs, Googles of the world. There's only a handful of those billion-dollar type of returns. And so, it goes to a few VC groups. And so most of the returns are clustered with a few groups. And so the average returns are pretty good, but you want to be at the top end of it where the dispersion for a buyout is a much tighter band.
I get it. Okay, thank you.
Through slide 10, as we discussed earlier, overall geographic portfolio, this US centric point made earlier, China about 7%, 7.08 to be specific. You can translate that to overall cap exposure. It's less than 2%, so not a major issue. One bucket I just want to highlight, various. Some people might ask what that is. It's really just a slew of other geographies that we have allocations through various funds that are just less than 1%. And I didn't want to list 50 of them on the pie chart. It would be really ugly. So we clump them all together in that one bucket that comes out to 9%. But that's all over the world, Europe, Australia, whatever have you, which actually is separate. I don't know if there are any questions, but yeah, US centric, that's also been decreasing as we saw earlier, the non-US exposure about 28%. Last time around when we looked at this slide, this particular chart, it was 76% US, if I'm not mistaken. So consistent with the messaging that we put out. Diving one level deeper, within the US, very well diversified across the country, not surprisingly, Texas, California, some of the larger states, larger pieces of the economy. Therefore, we have some larger exposures there. No direct Montana exposure at this point, unfortunately. Always in the back of our minds. We'll see if something comes through, but nothing at this point.
Invest in the whole state and still be less than 1%.
Probably, yeah, exactly. That's that. On the next slide, slide 12, our big sector exposure. And again, Terry's comment earlier, we do have an index here. We do have the benchmark on this particular slide. Just note that we are not managing to that particular benchmark. It's really just a reference point. We have large exposures to the top 4 or 5 sectors in the economy, and that is intentional. That's what most of the managers do. That's where most of the action is. And that's what we invest in.
In the top 4.
Top 4 or 5, yeah. So your typical industrials, IT, tech, healthcare, financial services. So that's what's driving the public markets as well. And that's where most of the private companies are active as well. Okay. Within this, just one note, we are continuing to be very selective with sector-specific funds within the US. So stepping a little bit away from a generalist that's playing across all of these sectors. We like folks that have a niche. One of the funds that we're currently underwriting is a healthcare specific fund, so that plays in that one sector specifically and hopefully able to add more value versus than just generally throwing money away.
And what's the real estate in this portfolio?
Real estate is interesting, so that it's not direct real estate exposure, to be very clear there. So we're not owning any buildings in here, like Ethan does in his portfolio. For example, one of the names that comes to mind, it's actually in a venture fund, is a commercial residential appraisal IT company.
Okay.
So that would fall into real estate as a sector because they're playing in that arena,
Okay.
but it's really a software platform.
It deals with
real estate, yeah.
We also have some distress managers that could have real estate exposure. We also have a general firm relationship with Centerbridge. Ethan presented Centerbridge Real Estate Fund. We're on their credit and buyout stuff. They do it as one firm, and so we have some exposure there as well.
Moving on to slide 13. Remember my discussion briefly about the vintage years. So this is an interesting chart now. Maybe I'll spend a minute or two here. So if you think of one specific fund investment, as I mentioned, and the manager calls that first dollar, that's the vintage year of that fund. Then we have an investment period of 2 to 5 years, depending on the strategy when the manager puts that money to work. So generally speaking, in the range of 3 to 7 years, that manager has allocated most of the money. The overall value of that fund would be at its highest point. At least that's what the anticipation is. So if you translate that from one fund to 80 and lump them all together in the portfolio as we have it, we would expect to have the largest allocation by market value in vintage years 2014 to 2019. And that's exactly that bulge you see on this chart, where the managers have allocated a lot of money, have a lot of money to put to work, and that's where we are in terms of the market value allocation to those specific vintage years. See how it tails out on the left-hand side. Those are some older funds that coming to the end of their life. So there may be some small amounts left in there. And then the same thing on the sharp drop off on the right-hand side, 2021. So we have made commitments this year, as you well know, but that money may have not been put to work. It hasn't seasoned yet. So that exposure to the 2021 vintage year in terms of market value is not as large as 3 to 7 years back.
But if the 2014, I mean, 2014, new commitment or.
So this is by market value, yes. This is actually about dollars in the ground.
Dollars in the ground. But so my question is that if in 2014, we have 50-year commitment, and in 2014, they asked for 10, then that's a 2014 fund.
Correct.
If in 15, 16, and 17, they ask for 10 each, that goes in the 2014 line.
Yes,
By investment,
by investment.
not by fund.
By investment.
So this is all down to the investment level.
Correct.
So a 2014 fund will probably call down in 2014, 2015, 2016, 17, 18. And so it'll be spread.
Yeah, but the fund itself would be spread out.
The fund itself is spread out, but on this chart, it would show as a 2014.
That's just the first year drop, right?
Oh, I see.
I believe so, yes. I'll have to dive
No,
into it.
now I'm confused. So is this,
Let me see if I can. So what you're saying here, this is showing if a fund makes an investment of, let's say, $20 million, they make the first one in 2014, the second one of the same investment. So 10 million in 2014, 10 million in 2015. It's 20 million is going to show in 2014 because it's one investment within that fund.
right?
Versus, okay, but if you allotted $50 million in that fund, then in the second year had a second investment in 2015 of $10 million. That $10 million is going to show in 2015.
Is it a bad sign that there's so much venture capital left? Because if I'm understanding this right, this is money we still have invested. Okay, so the fact that a venture capital fund hasn't come to fruition in 2010 and 2012 probably means that's not a good thing.
Not necessarily. Venture capital funds tend to be longer dated
Oh,
in general. So there are multiple extension options that the GP has, and these funds tend to live longer, opposed to 10 years. So it's not surprising to see that actually.
But that's a very astute observation. That
Is that
you want to move this tail.
Yeah.
We think of it as the 98, 99, 2000, that's really small, so you can't see it.
Yeah.
But things shouldn't be out that long.
Yeah, that's, and that the venture capital kind of goes, ooh, didn't work out.
Or even buyout.
Yeah.
You have a company for 15 years and haven't liquidated it.
Yeah, that's a good track.
That probably doesn't answer my question. Very astute.
I'll start with that next time.
That's why I gotta go with quantity.
Well, that was my section for now. I'll hand it over to Michael and with that vintage year discussion to lead into the private equity life cycle and pacing.
So slide 14 is just some color before we talk about pacing and why we need to talk about pacing. Now, this is an example of a private equity fund. This is often referred to as a J curve, where they're calling down capital in the early years, creating value over time, and then distributing that value. But if you look at the line, our cash flow pattern is negative for the early years until we get paid back money, and then it goes positive. And that represents the J curve. There's no questions there. We'll move on to 15. And so it's just one fund, it's pretty simple. But then when you add in, 125 line items, J curves like that, that's when you need to start thinking about pacing. Because commitments we're making now, the bulk of it's going to be called down in 3, 4, 5 years. It's not called down currently. And to Thomas's point, that's why you want vintage year diversification. Because we might be like, it's a great time to invest now. Let's invest $1 billion. That's not going to be called down until the next 5 years. And who knows what the market environment is like then. So because of the nature of private investments, you have to be a much more methodical and long-term investor rather than a lot of tactical investing like you might do within public equities or hedge funds or even fixed income, because it takes so long for the funds to season and for value to be created and for your capital to really be called down. Any questions?
So are you guys using this type of kind of a fund flow to time out your new commitments, and you're kind of projecting these life cycles out over the next 3 to 5 years and staging your new commitments over that period of time to kind of match those cash flows?
That's a very good question. On slide 16.
I'm good at that.
You read this, didn't you?
That's what you do. You read it and then you just ask the question on the next page. And then you look for this one.
So, we do this with the assistance of RBK. Thomas works directly with them every year when we run a pacing study. Generally, we'll run it annually. It doesn't really make a lot of sense to run it more than that. We're thinking of all the inputs, which is every line item in our portfolio, our expected commitments going forward, as well as the overall MBOI cap portfolio. And then we're running various scenarios, whether that's a negative growth rate, a flat line, or a more historical expected growth. And then we'll run different target allocations. Currently, we're running a 15% private investments target, but we will run other scenarios. And so that's how we get to a long-term pacing expectation. In this case, we are expecting 400 to 450 million per year. Page 17 is our pacing the last 5 years. You can see a jump from 2017 to 2018. And I think that's really when we committed to writing larger check sizes, fewer managers, and being much more methodical about our pacing. And so, I think the last couple of years, we've been very consistent in our messaging of our pacing moving forward. Slide 18. Something that we talked about earlier, kind of our mix of strategies. It changes from year in year, but we've been doing more private credit in the last couple of years. I think that's an attractive risk-adjusted return that provides alpha over other parts of our portfolio. That could change, but it's still attractive and accretive to the overall portfolio. 2021 is year to date. Most likely the private credit will go down a little bit. Slide 19. This is just an illustration where the dark blue line across is kind of where we're hoping to keep private investments as a percentage of cap. That one going down is if we didn't commit any new investments and what would happen to the exposure. It doesn't go down overnight because of all our historical commitments. They're still calling capital, and it'll take a long time for that to come off. Slide 20 is an interesting chart. There's a lot of information. If you just ignore the bar chart and you look at the dotted lines and then the other line in between, that's our policy ranges. And then the solid line is where the portfolio has been. So you can see the moves in the dotted lines. That's where we've changed the ranges. And so, we've been kind of in between the range the entire time. But if you look at the bar chart now, and you look at 2017, we were just above $1 billion. Today, we're above $2 billion in the portfolio. So while it might not seem like on a relative percentage basis, the private investments portfolio has grown twofold over the last 4 years, which is substantial. I think it's good to grow in this way, and we're still in the middle, and that's great. I think if we overshoot and there's a pullback, and we could be way out of line because these things take so long to season out. And so that's why we think so much about pacing and the timing of it. And we don't want to commit $2 billion next year. So it's a very large boat that we're trying to navigate. And so most of the changes we are making are incremental. But I would say that it's been heading in the right direction. We are growing it meaningfully in a relative and absolute sense in the private investment portfolio.
So I don't think I read this on the next page or anything. So play that scenario where, we have, the STIP and the overall cap, funds, retract, and then you're outside of policy. Is there any options there from kind of outstanding commitments and exposures, or are you just kind of stuck outside of policy for the time being?
So I think we have quite a bit of room. I think the back of the napkin math I ran is we have 20% pullback in public equities. That would move this less than 1.5% upwards. So we'd still be in policy with a 20%.
Okay.
Yeah. And
But
so
we did, a few years ago, we did sell some.
we did. That was opportunistic, not related to managing policy limits. But we sold about 75 million.
Right. So there is
there is
some
some
market,
Sure. Question.
liquidity before kind of rolls down.
there can be, right?
I can.
So
You,
I was just gonna say, I mean, we contemplate that stuff all the time. I know we talked about it with the board a little bit when we hit, March last year and we dropped, 30% or something in a heartbeat. We never did get outside the policy range, but I would tell you that I'm gonna come to the board and just say, we're outside of policy range and I don't think it's a good time to, go out in the secondary market and sell this stuff. So, we can either change the asset allocation range if you so prefer, or we can, live with it for a while and we believe it's gonna come back and, that kind of is historically and what happens. We don't want to react to this in a knee-jerk type of way and say, well, we got to be in the range because we understand why. But to Michael's point, I look at it all the time and you got to stress it pretty hard before we'd actually escape our range. So knock on wood, hopefully that doesn't happen.
But to your question, in the time like 2008, your real option is everything hit the fan. You're about to go over your policy limits. People are calling managers, asking them not to call down any more capital, considering portfolio sales. God forbid, I don't ever want to be in that scenario where we're panicking about how we're going to fund the private equity portfolio. But there's a lot of leeway, I would say, before we get close to that. But if needed to, we could sell on the secondary market. We're very aware of secondary pricing to buy and sell in the market. We look and have our portfolio priced at times. So we do know where the market is in the secondary.
Michael, have we ever bought on the secondary market?
We've bought individual line items before. And in the IPS, we have the ability to buy in the secondary market, and it's something we are looking at.
Excellent question, Carl.
That was
Did you look ahead?
No, it's wonderful.
Fun, yeah.
So Carl, I'm a little bit dodgy because I don't want people to call my phone, but I think we are.
No, I was just, yeah.
We are looking, it's interesting. It could be an interesting way to increase our exposure. If there's an interesting opportunity.
Okay. I remember when we sold, and part of it was, I know it was opportunistic. It was also a little bit of an experiment too, wasn't it? To sort of make sure we knew how it all worked and how it, et cetera. But I didn't recall a time where we bought it.
It's been rare, but there were a couple instances of just single items.
I'll move on, page 21. This is purchase price multiple. In the investment update, I usually just reference the current purchase price multiple. This is a historical chart. You can see it that we're at the high end of things. A really interesting data point is if you overlay public market multiples. So historically, they've been fairly tight together, but there has been a divergence. And so public multiples are multiple times higher than privates. And so, if you believe in kind of the historical precedents, sometimes they will revert. And so, I think that is a positive for our portfolio. It'll be a big year for liquidity in the private equity portfolio as they exit out. But it also does mean that private equity multiples could still go further up, which is good and bad. Good if we're selling, bad if we're buying, presumably at a very high level. Page 22. Debt level. Debt usage is high. Debt's readily available for a good company. And managers are utilizing debt. It's something we're cognizant of, and it's certainly a risk in the market at current levels of debt being used.
You feel like that's driven in part just by lower interest rates?
It is, yeah. It kind of amplifies as you go through the market. A lot of dry capital for pensions seeking yield, that money going into all types of credit products. That amplifies all the way to private credit, where they're more willing to take risk. Page 23. This is just private capital fundraising. You'll see 2020 off from a record high 2019. This is as of 6:30. So we're fully expecting 2021 to be a record year and to surpass 2019. It's certainly lining up that way. Page 24. This is the same slide that we've shown you the past 2, if not more years. And I think it's our expectation that we continue to follow these bullet points. I won't go through them, but I'll pause for any questions. And I'll hand it back to Thomas for investment process.
Do this relatively quickly, or we can spend a lot of time on it. But as I mentioned, you should have seen the slide, and to Michael's point earlier, this stems from when the overall private markets team was a much larger team who developed this process around how do we source, how do we underwrite these managers. But yeah, it starts with the deal sourcing. Obviously, both of us have individual personal networks in the marketplace. We reach out to other limited partners in the marketplace. We have a lot of connections with the managers that we invest in. We do get leads or interesting ideas from those folks as well. There is online databases, periodicals, market research that's done by other firms. All of these things flow together and just present a slew of investment opportunities for us. So far, year to date, we have looked at about 300 individual names at the end of September. You've seen the 6 commitments that we've made so far out of those. And again, those 6 were primarily existing relationships, as I mentioned in the beginning. That has been the main focus of ours. It's kind of a double-edged sword, but very blessed in the sense that we have such a deep and broad portfolio, that we have such a large number of very high conviction, very good managers that we can pick from. And that's what we've been doing for the past 1.5 to 2 years, focusing on those numbers, on those manager relationships that are back in market. And that will shift, go forward, but it'll also take time. Screening and due diligence, that is a very, very deep, detailed process. We had a nice meeting with Bruce. He's so kind to lend an ear for an hour or so. I'm more than happy to dive into specific details there, but just know that we're stacking up or exceeding peers in the marketplace with our due diligence process. We're very proud of it. It takes a lot of time, a lot of effort, but we are going nuts and bolts down to the nitty-gritty with on-site visits. I'll make a comment on that quickly. But it's a very thorough, very deep process, and we're not just blindly investing in an opportunity because it has a nice cover sheet on the pitch deck. So that's not what we do. The on-site, I just wanted to mention that briefly. That is a big part of the due diligence process. I personally like being in the room, looking at folks in the eye, shaking some hands. You hear those comments from Ethan as well. It is a big part of it. I feel that's where you get the best sense of a true partnership and a true personality. Much better than on a Zoom screen or just on a phone. To the point that we've been focusing on these existing relationships, that has lagged for sure. We have not done as many on-sites. We feel comfortable doing it this way at this point in time because we have these established relationships. We have been doing these on-sites. Some of them even maybe 18 months ago, 20 months ago, 2 years ago. So that is currently not an issue at all. Go forward, that will have to change. But I'm hopeful, looking into the future with vaccines, travel restrictions being loosened, that we have the ability to travel go forward and can pick up on that very important part of our due diligence process. Again, currently, that's what I mentioned with this double-edged sword, we have a large stable of existing relationships that are coming back to market, and that is currently, when we're looking at our pipeline, stretching well into 2022. So we're not in any situation where we're pressed for new names per se, but we are reaching out and looking at those. And yeah, with the ongoing loosening of travel and so forth, I'm going out on a limb here, but I'm hopeful that we can pick that up anytime soon with traveling and doing more on sites in the marketplace. And after an investment has been sourced and we dive through the due diligence process, again, there's a lot of questionnaires, data driven. Probably present that next time around. Some of the spreadsheets, John, you mentioned that. I don't know if it's interesting for the folks to see, but just the process that we go through and all the individual data points. Ultimately, when we have an idea or an investment that looks really interesting that we want to pursue, we present it to the cabinet. As you will aware, it's Dan Villa, John Putnam, the asset class directors, and the person who's presenting that deal. And then, have you ever had a deal that was not unanimous? I don't remember.
It doesn't need to be anymore, so.
It doesn't need to be unanimous. I know, that's why.
It's unanimous by one.
Yeah. So no.
Okay, good. So usually consensus. But yeah,
But everybody gets to chime in on that.
everybody
I mean,
gets to chime in,
has
everybody brings
questions.
in individual
You know,
perspective.
There's particularly a lot of good, questioning coming from these guys to say Ethan's World and vice versa, because, they hear very similar things. They all understand the process well. So there's certainly value in everybody being able to ask questions. Management questions or whatever it is.
Around concentrations, exposures.
We want to hear it all. So, yeah.
The next step, the legal review, let's have legal counsel DLA Piper do background checks on the key personnel and the individual strategies. And then from there on, it basically rolls in the circle into the fund monitoring, which we've gone through in this presentation, what we look for there in terms of exposures, concentrations, and so forth.
Do you do that on re-ups too?
Yes, we are doing the exact same process on any re-up, minus the just mentioned on-site, for example.
Right.
Where we are comfortable enough, it's like, hey, we know this team very well. There haven't been any major changes on the strategy or the team. We saw them 20 months ago on an on-site visit at an annual meeting. We felt comfortable to pass on that, but other than that, it's basically the same process, whether it's a new manager or a re-up.
So I mean, the whole contract's reviewed again and the background checks are done again and the new questionnaires are filled out again.
Yep.
So, Thomas. And I want to thank you and Michael for getting together with me. And for those of you who haven't had a chance to look at those questionnaires that they use, there's 2 of them. They are extraordinarily in-depth. And if you get past the first one and get to the second one, that's an accomplishment in and of itself. I guess my question is back to your observation about, I sense a desire on your part to be able to go out in the field and start looking at new firms, because while we've had the benefit of an existing pool that we could re-up with, at some point, we need to, look at new investment opportunities out there. What kind of time frame are you looking at? What's your time horizon? If you could pace it with kind of a transition from adding to investments with existing firms to more investments with new firms. How far out in the future are you looking at that?
Very good question. I can't put a time frame on it. As I mentioned, the current pipeline we're looking at right now is stretching well into probably halfway through 22. And there's already certain things that we presented to you maybe 2 years ago as a re-up. These are the folks that are now coming back, slowly coming back to market. So there, I didn't mean to ring any alarm bells that we're running out of opportunities or managers by any means, but yeah, put a time frame on it. I don't know, 2 years.
I guess I'd probably characterize it differently.
Yeah.
I don't think we are looking to transition the portfolio from current relationships to new relationships. I think I'm not saying that you're characterizing it that way, but it's been a very large portfolio historically. And so we've consolidated to our highest conviction managers. And so to your question, I think we will add new names going forward to augment the portfolio, but you won't see a wholesale shift, even if travel was open.
And Michael, I wasn't suggesting that we were going to go from all re-ups with existing manager to all new managers, but a gradual transition like everything else we try to do around here, turn the boat. If we're going to turn the boat at all, we turn it a little bit at a time.
I think maybe,
And so my question has kind of to do with at what point should we potentially start to be concerned if you're not able to do that? Because, I mean, we don't know what we're facing with COVID and all the other things going on in the world right now that we as a board might be able to help you with and aware of would make us better able to adjust to a less than optimal future situation.
I think it's probably been hampered in the last year and a half, but the group has looked at new prospective managers and done on-sites. And travel is slowly picking up again. And so possibly in this year, you will see a new manager relationship and most likely next year.
Okay.
Yeah. So it's not like we can completely turn this spigot off. But, you know, I think that's opening up again with travel and meetings. We should expect new strategies and relationships in the next year. Nothing crazy where we need to refill a pipeline and you won't see a new strategy for 5 years.
All right.
the pinch points right now, Bruce, are, I think US is kind of slowly back up to some travel. The tougher ones probably to the extent that we have international relationships where we might need to go somewhere. And I think we're, Dan and I guess, comfortable at this point, probably sending people at least to some parts of the world because we're not sure they are going to make it back. I don't think that's positive or something. So,
There's a good sign you're in trouble, Thomas.
Yeah. But we're getting there. I guess I'm hopeful that we'll be there
Going
next year and that won't be much of a constraint, but kind of more of an operational thing that they're not looking at stuff or something, or that, there's some things probably in the wings that maybe we go start doing visits if we could. We'll get there, I think. Hope.
That was pretty much it from my part. Again, with the appendix, we have a lot more detail, line item by line item of the individual managers. Happy to.
If I'm
address any
reading this
questions
right,
there.
so I'm on page 27. So the multiple on invested capital, if you go down that, so if somebody is below 1, we lost money. And if we're above 1, we gain money. And so this is since the beginning of private equity with the board, correct?
Partially correct, yes. So those are the investments that we still have investments
okay.
with, so not necessarily
Oh,
funds that were
forever.
completely.
Because I think it's
realized.
remarkable on the buyouts, there are only 6 out of what, 3, 4 pages that we lost money on. And in the venture capital, none of them. And we actually made on that, what is it, on the Northgate, 4 times over. That is pretty impressive. If we looked at the earlier, would it be, I mean, have we been that successful over time? I mean, that's pretty, I think that's pretty cool.
I would say yes, but no, we certainly can follow up with the overall portfolio.
and-
All this would
yeah.
just completely influence.
No, I
this,
don't want you to do
presentation
any
here
work, but
with
I mean,
another
I
10
think
pages.
that's kind of incredible because I would think in private equity, you're getting better returns because you're taking more risk. But in fact, to have only had 6 out of all these deals that you lost money on, and none of them went to 0. I mean, it was worse, it was half. I just think that's pretty amazing, actually.
I guess one thing I would say is, at least post 08, we've had a very strong.
Yeah,
it's a
we've
strong
learned
Yeah,
the entire
that's true.
time, So
That's
there's
true.
been a tailwind there,
Because I was thinking it was from the beginning, but no, I mean, we may be lost on some of the earlier ones, but still.
Yeah.
So the market,
There's a relationship there at least.
so let me make sure I understand this right. The market value is what's the current market value as of?
Current market value as of
evaluation?
6:30, exactly. That's what that list is limited to. So we had investments in the early 90s that
Yeah.
were completely realized that, the track record is part of our track record,
Of the 13.
but there's no more
Yeah.
active investment happening. There's a 0 market value. So I didn't include those in this particular list
Right.
because again, we would add another 10 pages to the appendix.
Exactly.
Happy to provide that.
No, but I
These
just,
folks want
I
to
still
see
think
it,
it's
but-
pretty amazing. So if the MOIC number is more than 1, we made money. Pretty good.
So there is a couple that we lost. The IRR is negative,
Well, there's 6.
but not on any specific one, but what's the feedback loop? So what do we learn from some of those?
It goes back to the discussion that we had earlier in the underwriting process. We're taking risks. We're well aware that we're taking risks. We're trying to manage those and minimize them as much as we can. There are funds that don't work out. There's no secret, and we try to avoid those, obviously, but ultimately we are not in somebody's personal mind decision-making. So one of the GPs that might do something silly or an investment is not panning out through some macro theme that completely went off the rails. We don't sit in those decisions, unfortunately. The feedback loop lessons learned is that we put all that emphasis in the underwriting and due diligence process and try to avoid those actively.
There's nothing that you could go back and say, hey, we missed this. We should have seen that in the beginning.
Do we have a particular example?
I mean, I know you're not perfect. I mean,
Well, this is not our track record. These investments were made for me and Thomas,
Yeah.
and so we don't want to be too critical.
Oh, you guys are perfect. It's the team.
Team Brian was, yes.
But I think, Jack, to your point, I think there are signs of that in firms where they grow too fast. They raise, 500 million and they have a 3x returning. And then the next month they raise $5 billion. And then they add a new team or they add an office in South Africa, or, they add a credit strategy. And I think those are flags for us. For teams that do really well in buyout, so they had a VC team that doesn't have a track record in doing it. I would say in general, as a cohort, these are very sophisticated economic animals that are driven to make lots of money for themselves and for their LPs. And for the most part, you invest with thoughtful groups that think about long-term relationships they have and have a track record of being good at what they do. They just continue to do that. And so we look for consistency, good partnership. People are, you know, thinking about long-term like we are.
So the older funds with a relatively low market value compared to the original commitment are completing the cycle.
We're coming to the end of that
The
life.
newer funds with a large commitment with a smaller market
Ramping
value
up at
or
this
sort of
point,
ramping up.
exactly. So that goes back to the comment that I made earlier in that middle part of the life of a fund, somewhere between 3 and 7 years. That's when you typically see the largest market value or money allocated in the fund, relatively speaking, to the commitment.
Right. So just. Looks like it's page 30. In the middle of the page, I'm just trying to get this. So you got Axum Asia 5. And looks like they've drawn significant amount, and we've got significant market value. So what's the situation then with Blue Sage Capital 3?
Very different strategies to begin with. Axiom Asia is fund-of-fund investments, fund-of-fund investment,
Okay.
excuse me. So they're allocating dollars to underlying managers. They tend to be quicker in the deployment
Right.
of the capital. Blue Sage is a true small size, lower middle market buyout strategy that has deployed capital a little bit slower than the average to get it to that point, but not to a point of concern from our view. But
So
yeah,
Carl, that's a good question, you know, to pick that out. Blue Sage is a manager that we have, you know, questions about. You know, it's 2018, so it's 3 years in. They've only called a fourth of their capital.
Right.
They're not on pace to hit their investment for 5 years. They still have time, and they could have add-ons and other things, but they're below kind of an average commitment basing. And so that's when we would ask them, you know, why are you guys below? For them, they're very value oriented, and so they don't want to pay up. So that's good and bad, right? It's okay to pay up if you're going to make more money on top of that and sell it for more. It's not good to pay up just to pay up and then end up being in a losing company. So that's, you know, someone we would have concerns about as far as their pacing goes. Not like a red flag, but we would want to understand why they're pacing this slow.
I'd go with Veritas Capital, by the way. If you want my advice.
we have. Yes. I believe we're in 4 funds with Veritas.
We're in them again.
Yeah, they're one of the highest performing private equity managers
That
in the
is,
market.
yeah, consistently top quartile over the past 4 funds.
If you Google them, there's a very nice article about the founder in Forbes right now, talking about his family and kind of how he got to this stage. Very different upbringing.
Just to get how to read the charts. Now I'm on page 28, and I was just looking at Axiom Asia Private, and this was in earlier 3. So we put in $25,000. It's 25 million.
No, wait.
Okay, I'm on
Right in the middle
28.
on page 28.
28.
Okay. Oh, Axum Asia. Prep.
And the market value is currently about 75 million. Are they paying us out something, or do we just have it on paper?
No. So there's a delta between them, right? Where 25, just roughly 25 million at a 4.5 multiple would be 112 million.
Oh,
Our
I
market
see.
value
And
is
this
only
is what's
75.
left. I see. So we have had payout, and this is that's left.
Correct.
Wow.
Yeah, that's an outstanding fund
That's a
for
very fun.
a fund of funds to return 4.5 times.
I don't remember you putting me in that when you were a broker.
Well, you had 25 to put in, didn't you?
Oh, before I met Terry. Sorry.
Wow.
That was a really, that's best in-depth on private equity I think we've had, or at least maybe I did that attention or something. That was good.
Yeah, that's pretty much what we had, unless, and there's a few more slides on the investment process detail. I'll walk through it.
This is communication page 34. Look at the top managers. Axiom is the top and Veritas is the second. So these work well.
Yeah, we did.
So two slides on the overall top 10 allocations within that.
Okay, great. Anything else? Fantastic, guys. Thank you very much.
Thank you.
Thank you.
Thanks, everyone. Nice seeing you in person.
Yeah, it is nice seeing you in person. Sort of behind the mask in person.
Okay.
Okay, folks. I think that's it on the agenda for today. So unless somebody has anything else, we'll adjourn until reconvene at 9:30 at the board, 8:30 in the committee room to complete our HR.
Probably 15, 5:30.
5:15.
My husband thought I was gonna start.
What, are you getting the food break session?